So welcome back to learn another advanced option trading strategy, and that is called as a butterfly spread. All right, an interesting strategy. I will be very slow and deliberate, and I would urge you to listen very carefully. If you recollect, in the previous strategies that we have studied so far in this section, whether it was straddle, the short or the long one, or whether it was a strangle, or whether it was a butterfly or the iron fly, or whether it was an iron condor, in all these strategies, we had used a combination of calls and puts, isn't it? Now we are going to learn a strategy where we shall be using only call options, no requirement of put options in this strategy. And this strategy is called as a butterfly spread. All right, listen very carefully. Let us say that the stock or the index is trading at 100. Dollars or reals or rupees, don't worry about that. Just try and understand the concept. So if the stock is trading at 100, 100 becomes the ATM at the money, isn't it? What you do now is that you buy a call in the money. So in the money means on the left of this 100, let's say at 90. And because you are buying a call in the money, you pay a high premium. Let us say $15. All right. So you pay a premium of $15 here, and simultaneously you buy a call out of the money here, let us say at 110, and because you are buying out of the money, you pay a small premium, let us say $2. All right, so you pay a premium of 2 here, a premium of 15 here, total $17 you have paid. Simultaneously now you sell two calls at the money at 100 here, you are selling here. And because you are selling at ATM, the price will be somewhere in between these two, 15 and 2. So let us say you sell at 7 each call, you get a premium of 15 because you are selling two calls. All right. So the net premium that you have paid is 15 plus 2 minus 14 which you have got back here. So net $3 premium you have paid. Don't worry about these figures, they are only for the purpose of explanation. The real figures will depend upon the asset that you are trading and the time of expiry cycle, whether at the beginning of the trading cycle or in the middle or towards the end where you are trading, the price will depend upon that. All right. So now this is the payoff diagram which results from this trade. All right. What is it? The break even is at 93 and 107. The moment you go below 93 or you go above 107, you start incurring losses. Your maximum loss will be restricted to the $3 premium that you have paid. But as long as you remain within this 93 and 107, you will be in profit. Your maximum profit will be 7 when the asset expires here exactly in the center at 100. All right. So what you have done in the earlier case when it was a butterfly, your profit was 6. Now you have stretched the butterfly and you have increased your profit to 7. Okay. Just by stretching that, you have increased your profit. But as I told you earlier, nothing in the stock market comes free. There are no free lunches. It is a level playing field for the buyer as well as the seller. So if you get something, you have to give something. Here in the butterfly, your profit was less, so the safety space was more. You see, you had 20 points of safety here. Within this range from 90 to 110, you were safe. Now you have stretched the butterfly, you have increased your profit. So therefore, your safety space gets reduced from 20, it is now reduced to 14 points. All right. So you gain on one hand, you lose on the other aspect. Now, because these two edges you have gone long, you see, you have bought the call, you have bought this call on the edges. Therefore, this strategy is called as a long butterfly spread. And this strategy is suitable when the market is stagnant or range bound or moving within a very small range. All right. The moment the price goes out of the range on the lower side or the upper side, you will be in a loss. All right. You will profit only if the price remains within the range. If you go short on these two edges, instead of going long, if you had gone short, then it will become a short butterfly spread. Let us see how that short butterfly spread is made. All right. So listen carefully. Now in a short butterfly spread, what you do, you sell one call in the money, that is here at 90, okay, and you get a premium of $15. In the previous case, you had bought the call, so you had to pay the premium. Now you are getting the premium. All right. You also sell one call out of the money here at 110. So again, you get a small premium. Let us say $2. So $17 you have got the premium, and you simultaneously buy two calls at the money here. Now, since you are buying, you will have to pay the premium. So 7 into 2, $14, you pay the premium. The net premium that you receive is 15 plus 2, here, 15 plus 2 minus this 14 which you have given. All right. So net $3 premium you have got now. And this is the payoff diagram which comes out of this strategy. All right. The same thing but inverted now. Your maximum loss is $7. When the asset expires at exactly 100 here in the center, that is your maximum loss. Your break even remains the same. Your maximum profit now is $3. That is the net premium that you have received. Exactly opposite of the previous case when you had gone long. All right. So what you have done, the butterfly has been spread, but they are now inverted. All right. Now, because on these two edges you have gone short, you see you have sold here. Therefore, you call this strategy as a short butterfly spread, the opposite of the long butterfly spread. All right. And this short butterfly spread is suitable for a volatile or a turbulent market. To profit from this, you have to get out of the range. You see, either on the left or the right. Either the market has to fall or it has to rise sharply. If the market remains stagnant or range bound, then you lose. Okay. So if the market is volatile or turbulent, then you may go for a short butterfly spread. All right.